Good day, Market Chameleons and everyone joining for the first time. Thanks for coming by and watching the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. He's going to be talking about how to graph potential payouts for calendar spreads. How you doing, D?
Good morning, Will. How are you?
Great. Let me share your screen. And there we are with the Market Chameleon landing page.
Yeah, and I think what we'll do today is set up a calendar spread and look at a potential payout diagram, because when we talk about calendar spreads, it's not as easy as creating a payout diagram for an option or a strategy where all the options expire on the same expiration, because at expiration the option's either worthless or it's worth whatever parity is. If it's in the money by $3, it's $3. But calendar spreads don't work that way. And let's first set it up. We'll talk about it and then run a payout diagram. And I'm just gonna type in Google. We'll do an example on Google. Put Google in here in the search box. It's going to take us to an option chain. It'll take us first to Google's main summary page. We're going to use this menu on the side. We're going to click on option chain. I'm going to click on this menu to minimize it and expand our screen. And from the option chain, we see that we have all different options available that are listed for trading. On the left-hand side, we have the expirations. And if you click on an expiration, it brings up the calls and puts and the different strikes available in that expiration with prices to trade. So a calendar spread involves two legs. You're buying an option in one expiration and then selling an option in a different expiration in the same strike. So that's a calendar spread. And you could either buy the longer dated option, sell the shorter dated option, or vice versa. But since they expire in different expirations, how do we figure it out? Like, well, what is the potential payout? Because when one option expires, the other option didn't expire. And, then, let's say you do two expirations. One expires in 10 days, one expires in 20 days. Well, after 10 days, the first option expires. So that one will be either worthless or will be in the money. So we'll be able to figure out at expiration, what it could be worth based on different stock prices. But the second option, originally it had 20 days to go. In 10 days, it'll have 10 more days to expiration. It still has time value, meaning it didn't expire yet. And it could be worth anything at that point, because it will depend on, not only the stock price, but the implied volatility, how much premium is left. There's still going to be time premium, and time premium will be also the implied volatility at that time will be a factor. So we don't know exactly how to plot that, and we have to create these estimates. So let's put one in and see what it could potentially look like. And let's say we do a time spread in Google, and we're going to go out a little bit, let's say we do December 26th. I'm going to click on that. This brings up the December 26th expiration. And let's say in our example, we decide to do a long calendar spread. So long calendar spread would be, or debit calendar spread will be, we're going to sell an option in the near term and buy an option in a further out month on the same strike let's do a call spread. We'll do a call calendar spread, the same strike and call. So December 26th, let's start here. Google right now is 318. Let's just do a 320 strike. So we're gonna sell the 320 call, and to simulate that, we'll click on this to make it easy. We're gonna click on the bid, and this assumes, okay, your first ticket, you're selling December 26th, 320 call, and it populated for us the price 840. Now we could change these in here if we wanted to, but it just defaults that way for us, and then you could change it if here manually. But we're going to keep that. So that's the observed bid at this time, 840. Now, to complete the calendar spread, we've got to go and buy another option further out for this long calendar spread. So let's go out on, I'm going to use, we're going to keep this ticket up. Let's go for our next ticket, next leg. I'm going to go to, let's go to January 16th. Okay, so I'm going to click on January 16th. And now this brings up a different option chain for January 16th. We're going to find the same call. We have the 320 call. So now the 320 call here the bid is 315, offers 1330. So we're going to click on the offer. So we bring up a buy side ticket. So click on 1330. And now we have the next leg, buying Jan 16, 320 call for $13.30. Again, we're going to just keep these prices here because we want to just evaluate these market prices for now. But how does that look like at expiration? That's harder to visualize, because a call, just a single call, you could kind of visualize, right? If the stock goes up, eventually it's in the money and it'll go up 1 for 1 with the stock, at parity. If the stock goes down, it'll be worthless. So you could kind of visualize it, what a call would look like at expiration. But these strategies are not that simple. So we're going to run an analysis just to get a view for it. And once we run an analysis, we get all these different analytics for us. Here's the first payout diagram, which it says here on December 26 expiration. This is the estimated view of this. Okay, so keep in mind we can't go to the second expiration because the strategy as a spread, as a time spread, it will cease on the first expiration. That first expiration, the first option goes away. It's either going to expire worthless, then you only have a call left, or if it's in the money and you do nothing, it gets converted to stop. Right? So if this call is in the money, well, after expiration, you do nothing, then you're going to be short stock and long a call. So we got to figure out at that first, where this call spread, calendar spread, at that first expiration, it ceases to be a calendar spread. So that's where we have to figure out. So now we got this first expiration. This is kind of what it looks like. So you could see that it almost looks like a short straddle, but not exactly, because you could see then you kind of level off on the wings. So almost like a kind of like a maybe butterfly. But let's expand this. We're going to go here in the summary, and we're going to select the payout diagram so we could kind of see it, a little bit longer. And this is what on December 26th, the estimated looks. So ideal here, your sweet spot, it's saying is right at 320. So you could see here, December 26th, right? It's saying at expiration, 0 days to go. So that means that on December 26th, this is going to be parity. And on the January 26th expiration, right, which from today has 43 days to go, but it'll have 21 days to go at that December 26th expiration, right? So this is going to go, today has 22 days, but the payout diagram is saying, well, we're going to run this at expiration, 0 days. And we could change that, okay? We could do it a little bit earlier, but let's just say at expiration, 0 days, this will have 21 days. So this will decay, right? They both will decay. This is taken into consideration. And it's saying that the implied vol right now is 31.3, and we're going to keep it at 31.3 for now. So this is what it would look like, that it's saying, well, your sweet spot is 320, right where the strikes are, which kind of makes sense, because if you're doing a time spread where you're selling the near term, and if at expiration the stock is right at that strike, well, you're going to collect whatever you sold, you collect that premium, and that option goes away. That means you collected the premium, it decayed, went to 0, so you kept that, and you still have this other option that goes out further. Yes, there's going to be loss in time premium in that, but if the stock is right at 320, well, that means that this longer term option will be at the money, right? And when you have an option that still has further out to go, when you're at the money, that's where the time premium is the greatest, right? Where it's all time premium. Once your stock is at the money, that option is all time premium. That's where time premium is the greatest. If the stock moves away, let's say the stock goes down, well, that option loses value, right? A call option loses value as the stock goes down. If the stock goes up, it'll be in the money, but with less time premium, right? Because both of these options will start going in the money, but it'll have less time premium because it'll be further away from at the money. Okay. So as it goes more and more in the money, it becomes more, acting more like stock and less of time premium. So this chart kind of shows us that, okay, our sweet spot is right 320. And as it's moving, here are the break evens. These are the break evens. You could see here, these are the profit and loss estimates, and these are the different stock prices. So I'm going to come down here. Another question is, this is based on the implied volatility not moving. So this is assuming, well, if the implied volatility today is 31.3, we're going to keep it constant and see what happens. So the implied, if it's 31.3 on December 26, this is kind of what it looks like. But it could change. This implied volatility could change for sure. It could go up, it could go down. So now we got to shock it to give it different scenarios. Okay. This is just an estimate based on an assumption. It's based on this assumption, 31.3. So I'm going to come down here, and we have some statistics here to help us out. So the stats here are saying, okay, your first leg, here we have historical implied vols to kind of look at, so the average implied volatility on the current day, with 22 days to go. For this leg, it's 27.1. For this leg, 27.3. The median volatility here and the high-low range. So we can, and this just helps us look at historicals to be able to shock our payout diagram. On December 26th, this is saying, well, this is going to have 0 days to go. So implied vols are irrelevant, right? It's going to expire. But this option with 21 days to go, it's going to have an implied volatility. And historically, with options, 21 days to go that are, this far away, the implied vol on average is 27.1. The median was 26, and these are the low range, 12.9, 7, high 79.7. So what if we said at expiration, the first expiration, 22 days, if we fast forwarded and the implied volatility reverted to its average, on average, where these implied vols tended to be 27.1, what would this graph change to look like? So we come up here and we say, we're going to change this 31.3. That's the current volatility. And let's say it does fall to 27.1 on December 26th. Right? We want to see what would happen to our. So you see, I put it to 27.1. We've removed 4.2 vol clicks from today's vol. Okay. Well, that's going to impact this position. Remember, now we have decay in this option plus implied vol comes down. If implied vol comes down, premium comes down. So this is going to change. So let's run this analysis. And now you could see we have two graphs. One where the original, right? The original, this is the green and red. And now we have this dotted line, user defined, right? Where now we've removed 4.2. So you could see here, well, if this happens, if the stock is at 320, well, now the potential payout, instead of $478, it drops to $353. Okay. And you could see that the payout drops along the entire curve. So you could see that then our break-even point, so you see the break-even points, this zero line, come in. Right now the break-even point is, we don't have as much cushion for the stock to move. The original break-even point was like around here, right? So if I hovered there at 330, 340, that was our break-even. If the implied vol does come in like we did it, well, now it would be a $112 loss. Means our break-even point is closer to like, 329. Same thing on this side. So what we did here was now look at a potential calendar spread, called calendar spread. And we're running potential risk and rewards. What is our potential reward versus our risks, in the tails here. And I could run different scenarios now. Maybe I think implied vol will go up by 3 clicks. Let's say, if I add 3 clicks, 3.2, 3 clicks, what will it look like? So now you see that new blue line is above the original payout diagram where no implied volatility change. So it's important to come and kind of try to evaluate what are my potential risks versus rewards, where I think the stock, in my unique views, most likely to be in which range from here to expiration, and where I think the implied volatility. So then I could look at that and make a better, more informed decision based on potential risk and reward of the strategy. All right, well, I'm throwing it back to you.
That was a great webinar, D. Thanks for bringing that to the Chameleon community. Everyone have a great rest of the trading day and a great weekend, and we'll see everyone Monday. Thanks, D.
All right, thanks, Will. Thanks, everyone, for joining. Stay safe out there. Have a great weekend. Hope to see you Monday.
All right, we'll see you Monday, my friend. Thank you. Hey, everyone. Thanks again for joining the Market Chameleon free webinar series. D works really hard at putting these on for everyone. I hope everyone enjoyed it. Have a great, safe trading day out there. Remember, follow us on all those social platforms. If you're on YouTube, thumbs up, always appreciated. Everyone have a safe trading day and a great weekend. TGIF for sure. And we will see you on Monday.